Welcome to the What's Your Deal podcast, where we discuss business acquisitions, investments, management, and exit strategies. I'm your host, Matt Euler. Let's dive in. Well, welcome back to another episode of What's Your Deal. I'm joined by popular demand with Lindsay Denton today. Lindsay was on an episode a couple of months ago when we were talking about SBA financing. And Lindsay and I work together at WCI Business Brokers, where we help people buy, sell, and finance businesses. And Lindsay's responsibility to a large extent has to do with the financing part. She's become an expert in SBA financing for business acquisition loans. I rely on her heavily, as do our clients. So Lindsay, welcome back.
Thank you.
Yes, absolutely. So today we're going to talk about how to prepare your business for sale, and specifically some of the elements related to obtaining financing. So this is designed for sellers of businesses. However, if you're a potential buyer of a business, I think you'll find enormous value in this conversation. And we've also, as Lindsay and I had a great time pulling together this outline and laughing about all of the stories and things that we've learned over the 7 years that Lindsay and I have worked together, we also decided to turn this into a series. So we don't know exactly how many episodes Lindsay and I will do, but there's at least 2 that are going to be focused specifically for sellers of businesses and how to prepare your business for sale. So Lindsay, can you give us a little bit more of a description about what it is you do with WCI Business Brokers to help people, buyers and sellers, but in this episode focused more on sellers, be ready for the financing of their business and actually to get the business approved for financing?
Absolutely. First and foremost, when we do have a seller that comes to us at WCI Business Brokers interested in selling their business, most of them have never done it, or if they have done it, it's been years. So going through their financials, getting that organized, and then, of course, putting together exactly what we need in the long run. So what the lender's going to want to see, what a buyer's going to want to see, what maybe a buyer's CPA or attorney is going to want to see, so that when we get to that point, all of that groundwork has been laid. And then once we have the listing ready to go and we have a prospective buyer, then of course, helping the buyer through that process, which also includes the seller as well.
Yeah, so a lot of that footwork, as you're saying this, a lot of that footwork really falls on the listing agent. Mm-hmm. And whether that's with our firm or any business brokerage firm, in my opinion, designing the listing package so that it's ready to be submitted for financing is important. Mm-hmm. Because at least in our firm, about 70% of our transactions end up being submitted for financing. And unlike a lot of other assets where financing is obtained, a lot of the burden to be approved for financing is on the business and not on the buyer. Like when somebody buys a home, of course, it's how much money do you make and can you afford the home?
Absolutely.
With a business, it's really about how much does the business make, can the buyer run it, and can the business afford to pay for itself?
That's correct. So
your role also gets beyond, I know once we've got the financing process in place, maybe you can describe a little bit about what that includes with some of the activity that you enjoy so much and get to participate in.
Well, first and foremost, I'm a heavy believer in doing things right the first time.
Yes, I love that about you.
So with that being said, because I do play a part in most of the process, if not all of the process, as you said, making sure that package is put together ultimately so that if it is financed, that we're not going back and redoing things that were already done in the beginning or maybe weren't done in the beginning that should have been. So once it's packaged up and we have that listed, ensuring that what the buyer needs to see from a books and records standpoint, and along that process, dialing in each piece of that versus just on a global level, but each piece of that and what the lender's going to want to see.
Yeah, and it's the reason this is so important, of course, is we've had deals, and part of what made this episode fun for Lindsay and I is talking about some of the stories that we have remembered fondly. It can be a huge problem when you get a buyer on board and you're in the financing process, purchase agreement signed, books and records. I mean, contingencies are all happening. And then we find out something about the business that we didn't know that either torpedoes the financing ability or creates a huge snag. Sometimes even a huge snag, which is not the end of the world, but it can be delaying closing for months, which can create challenges with staff and all kind. I mean, it's part of what I enjoy so much about this industry is that it is deep. And one of the things I heard, which is such a compliment to you, is that a lot of the people in our audience said that they listened to the last episode we did over and over. Because of the technical information and the detail. And so a lot of our guests are people who are sharing their story. In this case, you and I are going to dive into the weeds on some of the very specific things that sellers can do and really should do to have their business ready to be sold and financed. So with that, let's talk about number one. I mean, what do you think is one of the most important things that somebody does when they're getting ready for this process to prepare themselves and their business?
Well, I guess it would be a request, if you will, and that's organization. A lot of sellers own their businesses and have owned them for years and years and years, and their focus is making sure their business is profitable and runs smoothly from the actual business standpoint. It's interesting. A lot of times we have sellers who, we start questioning things on their financials or just trying to get our arms around how they've ran their financials for the last 3 to 5 years, and they don't know. And sometimes their CPA doesn't know, or their accountant doesn't know why they did a certain thing, or they did it this year and then they changed it the next year. So having those things organized and having a clear understanding of your financials, at least a 10,000-foot overview to begin with, and then we can kind of dial in on that a little bit more as we move forward, is the best thing that they can do to start.
For sure.
And do favors for themselves and us as well.
Oh my gosh, it couldn't be more true. And as I'm listening to you speak, it's reminding me that we see part of our job is to try to find any questions that either a prospective buyer might have, and certainly a lender, before they have to ask. Because if you think about trying to present anything for sale, the more complete and accurate that information is up front, the better.
Absolutely.
And we've certainly had examples where there's some accounting mistake that a buyer finds. Well, it can just finish the deal. And going through the process of selling your business is not something most people want to do several times. It's like we find the right person, you get it done, and you get to the finish line because there's lots of consequences with that. So when you talk about being organized without any names, can you give a real world example of a scenario where somebody was not prepared or didn't have the knowledge they might benefit from regarding their accounting, and it came back to bite us? Can you share a story? Without tears?
Only one?
Yeah, and if we need to get some Kleenex, we can.
Well, there are several. I would say one of the minor pieces of that question would be a seller not understanding the difference of their compensation. So whether they were paid through draws or distributions versus actual owner's compensation that's going to show up on their P&L. And ultimately that ended up being, us going back and redoing all of their cash flows because of they misunderstood how their compensation was paid to them as an owner. And like I said, going back to them operating their business, that's their focus every day, is operating their business, not what their financials look like on a P&L per se, line by line.
Yeah, and so that's really an accounting. And so I'm going to dig into this. And again, maybe you can give us an example of the industry the business was in and how that played out. Sure. But there's a difference between a W-2 wage that an owner might receive, a distribution, a dividend, a draw. All of those things show up differently on a P&L and a tax return. And when it comes time to be able to demonstrate that to a buyer and or a lender, it matters. Yeah. So with that being said, what's the example? What's the business without the name, but the industry? And
that was a restaurant. Okay. Actually. And we've had this many of other times as well. We also have another one that comes to mind. A lot of times a seller doesn't necessarily understand their how their health insurance is going to be paid for through the business, or their 401k contribution is going to be paid for, and it may look different on a tax return versus their P&L. And so all of those pieces of their financial landscape, knowing exactly what belongs where, because that can certainly affect their bottom line and affect what their business ultimately is worth and what it's done over the last 3 to 5 years.
Yeah, and so to put that into perspective, a business broker, part of a business broker's role, and even if there's not a business broker involved, part of a seller's role is to calculate what the discretionary earnings of the business is. Another term for that people might be familiar with would be EBITDA or owner's cash flow. Most prospective buyers don't know how to calculate it. Even if they know how to calculate it, they're not familiar enough with the business to be able to extract all of the owner benefit that are within the financial statement. And that's really what you're talking about. If we, as an example with that restaurant, if we say, okay, the owner's compensation is $150,000, and we think that's W-2 wages, but we didn't get a copy of the W-2 or the whatever, if we make that statement and then we find out that it was actually only a $30,000 W-2 and the balance was actually a distribution which came from below the bottom line, it's not an add back. And again, I know we're in the weeds on this, but these are the things that bring us in our world in the middle of a transaction to a full stop. And that's where I think this is an example of why this episode is so important for business owners, is the more they understand that in advance, either A, they're not counting on their business broker or advisor to extract it correctly. They understand it going in. That's going to lead to a higher sales price in most cases because the discretionary earnings is calculated accurately, but it also avoids the opportunity of a prospective buyer misunderstanding or not being able to calculate it because it wasn't done up front.
Absolutely.
Yeah. So in that example that you're thinking of, and because we're not using names, I can't remember I can't remember exactly which one you might be talking. What happened? Was it caught in the listing process? Was it literally in the financing process? How did that play out?
Unfortunately, it was not caught in the listing process. Again, lack of organization that came to us. So it actually came when we had a buyer, and the calculation when the buyer was actually going through to figure out what the owner's cash flow was for their perspective, their ownership, is when it was caught. And unfortunately, it ended up being a reduction in the price and a reduction in the owner's cash flow ultimately, which that buyer was not able to move forward because they needed more cash flow.
Yeah, so that was the end of the deal. And do you remember how many months that transaction went on before it fell apart because of that one situation?
My memory serves me about 2 months. It may be give or take.
Okay.
And that's 2 months that we lost potentially in the listing or finding another prospective buyer, and time and effort on everyone's part.
Yeah. And we may allude to this as we get into other examples, but for our audience, it may be, it's a couple months. But one of the things that can happen in that time frame is staff find out about the sale, which typically we recommend people keep confidential for lots of reasons. But I'm familiar with an example right now where the seller, whether they were advised to do this or not, the seller announced of their pending sale of the business 2 months before it's supposed to close. And one of the competitors called me. This isn't one of our deals. One of the competitors called me and said, hey, did you sell this business? And I said, no, I didn't. I talked to them about it, but they had a buyer already. And he said 2 of their key people just came into my office asking for a job because the seller announced that the business is going to be sold. And the seller is not working on continuing sales, so they're not getting the hours they want. So if you're a buyer, if I had to predict the outcome of that transaction, there will not be one. Because what buyer is going to be in a position to buy a business with 2 key people gone and a reduction in revenue and profitability day one? And not only that, 2 key people that are gone and now working for the competitor. So it is so important to try to have all of the ducks in a row and everything documented correctly and follow the appropriate process when it comes to preparing your business for sale, so that once it's on the market and you're going through the process, it is game on. Because a lot of times people can't turn back. So,
it's similar to tying your shoe, getting ready to go out to a baseball game. you don't tie your shoe before you go out, you're going to deal with problems out there on the field. And that's basically what we do.
Yes. None of us want to trip if we can, if we can avoid it.
We try not to. I mean, things happen, but certainly if we can tie our shoe before we go out, that shortens that curve.
Yes. So let's go back even one step, because we just went through a transaction not too long ago where the seller decided to change their mind, right? And those can be very costly mistakes for the seller of a business, but not to mention the time. So for a seller to be committed and fully have processed what listing their business for sale and working through negotiations and all of that means in the long run. So walk us through that. What are some of the things that are really important? Why is that important? And then let's dive into that story a little bit and talk about how that played out.
Okay. We actually have a couple of examples, so I'm not sure which one you're alluding to. But both of which, ultimately the end result was they had changed their mind on listing their business. Most recently, the seller, we went through the process. We dove into their financials as deep as we could. And emotions can run a little bit high when the rubber meets the road. And like you said, ultimately, they've decided to not list their business. So, having a buyer that has spent time and energy and money on preparing to purchase the business, going through the process of obtaining financing, and then, of course, our time, all of these pieces play a part. And then ultimately the seller having the cards in his hand and deciding not to move forward.
Yeah. So specifically, I can imagine people in the audience wondering how that could happen. So let's talk through that. So from our end, one of the things that happened, so we listed the business about 6 months before we found a buyer. So that whole time it's being advertised, we're incurring cost and effort talking with buyers and then having the seller talk with buyers and interviewing and all of this process. And we found a gentleman who was a very qualified prospective buyer.
Yes.
He had actually been laid off from his prior position, his successful career, so very successful person, but downsized and was transitioning into buying a business. So he's unemployed, going through this process, enters into a purchase agreement and is working his way through the contingencies.
And incurring costs along the way.
And incurring his own costs along the way for books and records. Yeah, there was contractor's licensing. So he had hired a CPA to help him with his books and records examination, contractor's licensing, all these things. And he also obtained financing. So he was verbally approved and ready to be conditionally approved for financing, which is a staggering amount of work. And what had happened, and I understand this, it needs to happen before we get this. But it hit him where he realized that, you know what, I sat down with my wife and we were like, listen, I know I'm tired of this business, but can we really afford to sell the business? And his wife, I wasn't at that conversation, but from what I understand, his wife was like, I've been worried about it since day one. I mean, are we sure we're doing the right thing? And so they had this heart-to-heart, which I totally honor. They had this heart-to-heart conversation about, can they even afford to do this? And what are they going to do for an income after they sell their business? And without enough retirement in place, he's got to go get another job. And at, I think, mid-50s, so they decided what they had was better than the alternative. But we were so far down the road that financially that became very expensive for him to unravel in good faith. Again, he didn't argue about it. He was just like, okay, I've made a decision and then I made another decision and it's going to cost me something. And fortunately, the buyer was gracious about how that was going to play out. And so were we, of course, because everybody had a whole lot of time, energy, and commitment in writing.
Absolutely.
That we were going the distance. So a negative situation. But we've also had situations, and maybe you can speak to this, where people have a financial commitment they didn't know about, or there's something else underlying that, yeah. So can you give us an example of what that might be?
Sure.
And maybe a story.
Well, we'll start with the story because, of course, that helps with the material. So having a business that had been previously seller financed and that seller financing arrangement was still in place. And then the current seller of the business wanting to sell the business. And if I remember correctly, it was due to medical reasons, wanting to sell the business. And the buyer needed a portion of seller financing as well, which the seller agreed to, not knowing that part of their seller financing actually was tied to the real estate as well. So unfortunately, because there was still such a large balance versus what she was going to walk away with from the initial down payment, if you will, on the new seller financing arrangement, she didn't have enough funds to be able to pay off the prior obligation and move forward with the seller financing for the buyer. And so it did cause some definite juggling to make that happen. Ultimately, it ended up happening, but not knowing what those obligations are, and some of those can be, leased vehicles or prior SBA financing or, again, seller financing, any of those pieces, that not knowing exactly what your financial obligations are versus, what your business is actually worth, can get you down a road where you have to start making some alternative decisions, which, ultimately, if we would have known in the beginning, then we could have mitigated that.
Yeah. So I'm going to simplify it, because I know the transaction you're referring to, and it was a complicated dynamic, but to simplify it for our audience, the long and the short of it was she signed a purchase agreement agreeing to carry some portion of a promissory note, but she was not going to collect enough at closing to satisfy the underlying debt.
Exactly.
And that also occurs with EIDL loans. Most people's PPP loans have been satisfied by now, but SBA loans, we just had another transaction where the underlying debt was so substantial that when I met with the owner of the business, I said, listen, here's the top dollar that if this sells, this is what it's going to sell for. Are you able to clear the underlying debt? And they said, yes, that they're willing to work with us and they're willing to negotiate and all of that. We go down the road of getting that ready to be sold. And then their accountant says, no, you can't. And again, these are just things that are time, energy, money, and emotional strain. They were focused on ready to be done, not on, okay, grab another gear. We're going to be in this another couple of years because of those dynamics.
Exactly.
It reminds me that I think some of the unfortunate nature of our world is that most people have never done it before. And so these are lessons that they learn the hard way. Ideally, they're listening to podcasts like this and others where they're gaining some information. But I think it even though what we do, most people think is extremely complicated, if you were to simplify it with a simple example of, if you own a car and you owe $30,000 on the car, you can't sell it for 20 unless you're going to
write a check.
Unless you're going to write a check, right? So the fundamental principles are the same. They just they feel more complicated because there's so many moving parts and so many other things, but very similar. So what's another example of a very important way a seller should prepare themselves to sell their business?
So one of the most valuable aspects of a transaction, whether it's in the listing phase or once we have a buyer, is keeping that momentum, whether it's updated financials, whether it's getting any of the requested documentation that a buyer has requested for books and records, as well as, continuing with the business and keeping your trend with the business financially. So we don't want the business to all of a sudden lose revenue or make any major changes. So once we have that momentum, we keep going all the way to the finish line.
So that's a great point. And there's a lot for us to unpack in that. But momentum is definitely our friend, like in most things. And one of the things that I'm recalling is that we oftentimes tell people, listen, we're gonna mirror your pace if you're a seller, or the buyer's pace if they're the buyer. However, this too fast can be, speed can kill, right? But too slow, it's hard to start again. And one of the things that I know happens, and it's a little bit different for us, but with lenders, if they say we need this, this, and this, and they're working on underwriting a file and we don't get it to them, they close the file, slide it away, work on another one, and they will get back to it once we've provided everything. So, that's a great indication of momentum being our friend. But do you have any other examples or stories of real life deals where you can share where a lack of momentum was problematic and maybe positive momentum was beneficial. Yeah.
Sure. We've had several listings where, we've had interested buyers, and unfortunately, either the seller had an issue getting the financials reconciled and over to us while we have a buyer waiting, or we have a lender who, like you were alluding to, we have a lender who's ready to move forward on the underwriting process. And unfortunately, we don't have the details that are required. And, one thing about this business that is so amazing is every transaction, every business, every P&L, every tax return is different. There's not two that are alike. It's interesting when we have new employees in our office and trying to explain that to them as part of the education piece of it. You can't go back and just look at another file and say, well, I'll do it just like this, because that's not how that works.
That's true.
They're all very, very unique. So with that being said, making sure that when the seller is ready to get in that driver's seat and we're ready to go with listing it and finding a prospective buyer, that we stay, like you've said, momentum is your friend, and performing when needed.
Well, it actually goes back to being ready to sell, right? I think a lot of people, even when there's a broker or an advisor involved, it still takes a lot of time for the owner of a business to go through this process and provide documentation and field phone calls and interviewing buyer and so on and so forth. And it can be a huge problem in a lot of ways. Like, I'm thinking about some things like the financials as an example. If we have 3 months of financials at the beginning of the year and the deal just keeps dragging along, well, those financials get stale dated. And the lender and oftentimes the buyer is saying, okay, we want more financials. Well, that can take 2, 3, 4 weeks. And then you start the whole process of, okay, well, are the trends up? Are the trends down? And I mean, it is worth, like, use the analogy of getting in the driver's seat. When you're in the seat, get ready to drive because those things are not beneficial. And just like the staff example I gave earlier, there's usually not much good that comes from this process being slowed down unnecessarily. I'm all about appropriate timing to do the job right and to get what everybody expected they were planning on, but unnecessarily slowed down generally creates problems along the way.
Well, and there are occasions where that pace, slowing down that pace, can actually cause the business to go into its low season, or give a inaccurate picture of the business. We have 3 months of financials, now we have 6. Well, now they've gone into a slower season, whether it's the summer or the winter or tourist season or, whatever that may be, that will give an inaccurate picture of what the business actually does for that time period. So then that goes back to our going back 3 or 5 years of their financials and calculating and even trying to come up with explanations with the seller and helping the buyer feel comfortable with, now we're on a downtrend, but ultimately, we see that every year, or explaining that to the lender that the business is not just heading south, it's part of its seasonality.
Seasonality, yeah. So giving an example of that, we've got several deals right now where the seller gets the idea that they're getting ready to sell. Even in the example I gave where the employees are going to another, that person, that owner of that business took their foot off the gas prematurely. In my opinion, you stay in the gas through the checkered flag, right? Because otherwise you can have huge problems. And we've got, whether it's economically or otherwise, we've got several transactions right now where revenue is down some. It's not the end of the world. These are businesses. You can't have high tide all the time, but it is a factor that we need to know about and the buyer needs to know about. I mean, there's no secrets in these things. It just is what it is. But keeping that momentum is important because a lot of sellers are they're done. And one of the things we see is buyers come along and they bring a whole new excitement and enthusiasm for the business. And oftentimes it can do better after the sale, even with them having less experience because of what they bring to the table. But to your point, we've got another transaction right now where the seasonal nature of the business, buyers aware of it, sellers aware of it. But if we don't close this in time, the sale cannot happen because the buyer would not be able to have benefited from the high season to ride into the slow season. Again, no secret, just timing. And in that transaction, we're doing everything we can to get it to the finish line with the lender, but there's so many complexities. We can't control the timing, and we also can't control the lender. And in this transaction, we can't close without them. And so it truly is be ready for the game when you hop into it, be ready to drive the car and show up as quick as possible with whatever's needed to get to the finish line. So,
well, and another piece of that, you bring a buyer into the perspective, and you've got a buyer who may have quit their job, who is living on their savings, and they need this money to be able to close the transaction. But if we're not, pedal to the metal, if you will, all the way through the finish line, that buyer is not making a dime off of anything until that business is his or hers. And through that process, they can run out of money. Things can happen, divorces, anything,
And we've seen all of those.
Yeah.
I remember a transaction many years ago that got delayed, not extensively, but it was probably improper planning on the buyer standpoint. But they called me and said, listen, I don't have enough money to close. I've been living, to your point, I've been living on my down payment funds for the past 6 months. And that is not good. The number one reason for small business administration loan defaults is lack of operating capital. And so the last thing a buyer, in my opinion, wants to do is to get into a deal behind the 8 ball because of a timing issue and have the odds against them. Just horrible. Well,
and especially if they don't have a role to play in that. If the delay is on the seller's standpoint because A, their financials aren't organized and ready to go, or B, there's some sort of lender delay, or anything in the process that they can't control, but unfortunately they're the victim in that and spending their operating capital or their down payment funds along the way to hopefully make it to the finish line, that gamble that they do.
Yeah. And we'll talk about buyers in episode 3 or 4 or 5, whichever one that becomes.
Sure.
But that certainly is an element of the buyer being prepared, making sure they've got enough capital to finish.
A game plan.
Yeah. Because it is lack of operating capital is stressful in so many ways and can be devastating.
Sure.
So any other points that you want to talk about regarding this aspect? I think there's some elements of, again, understanding how to get to seller discretionary earnings and some of that's worth discussing.
And there's a couple of pieces of that. One of those would be when you have a seller who their financials, their P&Ls, we're waiting for a tax return, and then the tax return comes and it doesn't match the P&L. And there's many, many, many of reasons and justifications on why that happens. But let's say we have a transaction that's going on in October, November, and then December rolls around. Well, now we're getting close to the end of the year, and this is how we feel that the financials are going to end. And those have been given to the buyer, to the lender, maybe a CPA or an attorney that's helping the buyer in the process. And then ultimately the tax return comes and it's a plot twist. And there's many, like I said, there's many of reasons that can happen. But those are all things that we have to face as we move forward with the transaction. So some of those we can mitigate along the way if we know that the tax returns never match the P&Ls and what that means. Whether that's a cash to accrual conversion, or whether that's an inventory adjustment, or whether that's a holdback or the timing of income or expenses that are applied to the books. All of these things can play an important role in those end of the year financials.
Well, and what's funny about that, as you gave those examples, I felt the pit in my stomach because I could remember every single one of those
moments.
transactions. So let's dive into that for a minute. So some of those are just simply accounting and cannot be avoided. Us being able to predict them or working with the accounting firm to make sure that we understand them is one piece. And I want to talk about that. But some of them are also self-driven, right? So let's talk about the example of the transaction we had not too long ago where literally I evaluated the business based on a 10-month P&L in the prior 3 years worth of tax returns, right? Everything was moving along great. I come up with this number that makes financial sense. We start marketing it. We find buyers for that business. And if I remember correctly, that tax return was on extension, right? So we're waiting for year end, and it's around September or so before we get the tax return. And do you remember how much difference there was in discretionary earnings?
If my memory serves me well, it was about the revenue portion of it was about $250,000, and a majority of that would have gone to the bottom line.
Yes, and that's my memory as well. And so when you lop off $200,000 off of somebody's discretionary earnings, oftentimes that changes what the price of the business should be, what's financially feasible, all of those things. So this is a great example of we had phenomenal momentum. Here comes this accounting dynamic. And I actually remember going and meeting with the accountant and the two owners and talking through like, okay, I didn't see an adjustment like this in any prior history that I had ever seen. Why this year? What is it? Is it absolutely need to happen? I mean, is there something here that was discretionary on the accountant's part? Or what? And it was not. I mean, it was what needed to occur, but there was no indication that kind of adjustment was going to be made. And then to your point, momentum. Not a great time to put your tax return on extension because if we had known about that in March, it would have been a whole different ballgame and almost a year's worth of marketing and interviewing buyers and meeting with buyers and being under contract that just went down the drain with one accounting adjustment. So the other example, and maybe you can walk us through this one, was self-induced. Can you share that example with us and how that happened?
Sure. I believe the one that you're thinking about would be an inventory adjustment, and that goes back to the timing. So, and even the prior story is a timing piece of it when that adjustment was made. So if you make an adjustment every year for inventory, great. If you do it in December, that's fantastic. If you decide to do it in January of the following year, that doesn't follow the trend.
Right.
And then, of course, now we have this item that's on your P&L that shows you've gotten a $150,000 or $200,000 inventory adjustment that makes a huge impact on that interim P&L.
Yeah, and we had a client who also was worried about the tax implications, and so. Again, in that dynamic you can share, but that was self-induced to avoid roughly 40 cents on the dollar, which had the potential of costing $3.50 per dollar because of that dynamic. So can you share that story with us?
Sure. For lack of better words, that income was kicked the can down the road, and ultimately, that would be their final year owning the business, barring that we had a buyer, which in that case we did. And so now that was applied to their books, which that's when the rubber met the road on that one in particular.
So because we're not using names, I'm going to get real specific so our audience can figure out what happened. So the seller getting prepared for their what would be final return was worried about the tax implications. So he decided to withhold quite a few checks that were payments for, I'm being careful here, were payments for income or payments for jobs that were completed in the prior year. He held all those checks until after the first of the year and then deposited them in that year to make the prior year generate a lesser tax obligation. So from the buyer and the lender, because we were under contract working on closing, from the buyer and the lender, that created a huge problem.
It did.
Because again, the discretionary earnings, now all of a sudden we've got a trend of history financially. And then in the very last year, it plummets because the seller held deposits.
And then overinflated that interim year.
Yes.
That would have ultimately been the last tax return.
Absolutely. So these, if anybody in our audience is not understanding the significance of this, that was a multi-million-dollar transaction that could have gone completely down the drain. And fortunately, the owner of the business communicated that to us in advance, and I helped him understand what he had just done. And his accountant was quick to make the appropriate adjustments, and the buyer understand exactly what happened. But that could have been the end of that deal without any problem at all.
That's correct.
Yeah. So fun to talk through these again.
Well, and this kind of this goes right back to how we started this podcast, organized financials. So if we would have known that would have happened, or hey, this is what's going on, or this is what I've done, certainly we could have calculated that in the very beginning versus when it presented itself, which, I always use the example when you look both ways to cross the road and you get hit by a plane.
Right.
That happens frequently, unfortunately, and some of them are self-induced and some of them are not. They're just the nature of the complexity. But in that case, without the organization of their financials and the clear understanding, it certainly was the plane that hit us while we were crossing the road.
Yes. So in the time we have left, is there anything you want to share about calculating the financial discretionary earnings? I know we've also, and we can talk about it in another episode, we want to talk about trends and how people, sellers especially, manage trends.
Sure.
And then lastly, what gets included in a transaction. Which topic would you love to cover?
Well, I think add backs would probably be, coming up with the seller discretionary earnings. We have had some new employees in our office, and one of the things, 101 that I explain to them when they're learning how to cash flow, or I should say, becoming better at cash flowing, is stripping those financials. So, if I own a business and I pay for everyone's lunch every single day, that's going to be an add back. If I, run my personal vehicle through my business, that's going to be an add back. And there's gray areas in that, and there are black and white. So the black and white make it very simple for us to calculate the owner's discretionary earnings. But then there's also some of those gray areas, the non-recurring expenses. We had to replace our computer. We had to replace an engine in the truck. We had to, pay for an expense that we weren't anticipating having to pay for and won't have to pay for several years from now. And then there's also people that own businesses and they intermingle their financials and some of their financial obligations within their business. And those become a little bit more challenging, especially when it gets to the financing piece of it. So there are add backs that we can use for the purpose of determining the value of the business and that owner's cash flow. And then there's also add backs that the lender is not going to accept. So, if you're using your company card to go buy supplies, and those, when I say supplies, I mean groceries for your house, time and time again, that becomes more challenging. So getting those clean and pulling those pieces of the expenses out of your business piece of it, because ultimately you want to, I love examples. So it would be like selling your car, and you've got a stereo in the car, and you've got, seat covers and whatever else that you enjoy while you have the car. And then when you go to sell the car and you say, oh, by the way, you don't get the seat covers, well, that changes the perspective of a buyer, a buyer's perspective of the business. So, and of course, the lender is not going to value that car based on the fact that you have some fuzzy seat covers in there.
Absolutely. So there's so much there. So for our audience, let me just walk through how discretionary earnings is calculated in a real simple way. And then let's plug in some examples or share some examples of things that A, might not even be worth talking about, or B, are not financeable, meaning the bank's not going to recognize them, which can kill the deal as well. So discretionary earnings, real quickly overview, most businesses are doing everything they can to reduce their taxable income. So their net profit on the bottom line is going to be as minimal as they can make it within the boundaries of what's acceptable, right, and legal. That includes oftentimes people having a company vehicle that may be used part of the time for personal use and other. But when you think of a company vehicle, there's a difference between a work van and BMW, right? And so if the current owner of the business intends to keep the BMW when the business is sold, the expense for that car, and let's use lease as an example because that's real simple. If the lease payments on that vehicle are not going to be something that the buyer has, that becomes an add back. So we take the net income of the business, we add back the lease payments in this example, and we get seller's discretionary earnings. Now, typically, seller's discretionary earnings is one term for that concept. It'll include owner's salary, it'll include debt service, it'll include some fringe benefits like health insurance you just described. It could include rent for a home office, all kinds of things. Most of what I just used as an example would be considered bankable. So what are some examples that I'm sure you can remember from yesterday that would be unbankable? Trade shows. I mean, some of the things that are truly one-time non-reoccurring, but not bankable. Can you share some examples of those?
One of them, I would say most recently, would be advertising. So if you decided that you were going to pay for advertising for a period of time, and then you decide to discontinue that advertising, it's hard to quantify whether or not that advertising worked. So, for example, I advertised with this newspaper or with this magazine for a time period and it didn't work. So we want to add that back. Well, unfortunately, the lender's going to say, can you very distinctly say that none of your revenue came from any of that advertising that you put in XYZ magazine. And so a lot of times those are pieces that they will take out and say that is not a bankable add back. Again, like you had mentioned, trade shows or one-time events that the business had done or participated in and then did not proceed. Of course, that's a one-time expense that may or may not have worked. Well, can you say that every dollar you made off of the business, none of that came from not one customer who showed up at that trade show and said, I'm going to buy a product from that particular business?
Yeah, and it's those could be legitimate one-time non-reoccurring expenses. In the example I'm thinking of, we spent $30,000, our client spent $30,000 on a trade show. It was a complete flop. So of course they want to add it back. Like we are not doing that again. But again, from a buyer's perspective, and certainly from a lender, I mean, the lender doesn't care about it. They're not going to give that any credit. But even from a buyer's perspective, they're like, well, how do I know? How do I know that the new customer that you just got didn't come from the advertising associated with the trade? It just becomes a problem. And so it's one thing if the business is priced where that stuff doesn't matter, it's just icing. It's another thing if it's literally like it's not bankable without that add back. We got a problem.
Well, and in that circumstance, let's use a $30,000 add back, for example, a trade show or advertising for 1 year. If depending upon how we're calculating the value of the business, I mean, you can times that by 3 or 4 times. So if you take $30,000 and you multiply that by the multiple of what the business is worth, well, now you have a $90,000 amount that you're adding on to what the business is worth. Well, is it?
It's such a great point because back to the very beginning, somebody who's getting ready to sell their business may not want to take that risk. Stick with what's known. Don't deviate hugely from the standard procedure. Yeah, and try new things. I mean, because every dollar is worth a lot when it comes time to sell. So last example I want to give on this would be something that's more voluntary. And so there are certainly people, and again, I'm not condoning this if the IRS is listening, but there are certainly people that have a second set of books. And I met with a client recently that had, let's just say it was $50,000 a year. I've met with several recently that had, let's say, $50,000 a year that's not on the books. Well, back to our example, what is that saving them? 30 to 40 cents on the dollar. What is it costing them? $2, $3, $4 per dollar. Those are self-induced reductions of the business value. In so many ways, in my opinion, it is just not worth doing, not to mention that it's illegal, but it's also not something they should talk about. I mean, do you want to be spreading the word that you're doing this illegal thing? A lot of buyers will consider that a credibility or a character issue. and walk away from the business all on its own. And so the advice I've had for the two people where that came up recently is I said, listen, in my opinion, keep your business, show every penny that comes through that business, build the value of the most significant asset you own as high as possible by demonstrating what's truly happening, and call me when you're ready. Because otherwise you're just asking for trouble and you're selling something for far less than what you might be able to because of trying to save 30 cents. And I get it.
And that happens a lot with cash-based businesses or businesses that have a large amount of cash flow, I should say, in true cash. And in that example, that may not necessarily be a bankable add back. We can add it on there, but ultimately, again, you go back to the multiple of what a business is worth. Well, now you've got $50,000 that you said you received, but you put it in a coffee can, and now you want to count it as income for the business, but it does not show in the books and it does not show on your tax returns. And ultimately, you times that again by 3 or 4 or, sometimes even 5. And, you just took that off of your bottom line of what your business is worth for 30 to 40 cents on the dollar. Absolutely.
And I'm sure there are people in the audience that maybe if they're in that situation say, well, listen, there are people who will buy businesses. There are people who are actually looking for businesses like that. So I'm not saying it can't happen. But in our world, we just lost 70% of the prospective buyers we were dealing with or potentially able to buy that business because it's not financeable. So anyway, great stuff. Always enjoy these conversations, even though we have them every day of the week. It's fun to be able to share our world and what we learn and see every day with our audience. So I would like to ask you one last question. And I know you've had this question before because you've been on in the past on the show, but I still think it's valuable that none of us got where we are on our own. We always had somebody that gave us a hand up. And I personally focus on this every day of my life because I never want to forget how I got where I am.
Sure.
And so to give you a little bit of grace, to me, that's gratitude. And so if you wouldn't mind sharing with us one example, because this is how I finish all of my episodes, of somebody who saw something in you, gave you a hand up, gave you a little bit of confidence when you might not have had it, or just something that you're grateful for that's helped you to get where you are.
Sure. For anyone who has watched the previous podcasts that I've been on, there was always someone in every prior career that I had that either pushed me or, saw something in me that I didn't see in myself, or, drove me in a direction that I didn't anticipate going to. And there are several examples. And most recently you, when I started at WCI, this was not my intention. This is not what I saw in the brochure. And not that I was opposed to it, but certainly I didn't know where I was going in it. But I take these all back to, from a young age, my dad, I was an only child on my dad's side, and my dad always pushed me. And sometimes it seemed unrealistic for, a 7, 8, 10, 12, 15-year-old to be doing or having to do some of the tasks or lessons that I had to learn along the way. And I was thinking about this prior to the podcast. When I was, I want to say 14 or 15, my dad decided that I wasn't going to sit around all summer and, while all my friends were playing in the pool and, riding their bikes around, I wasn't going to sit around and do nothing. So at that point, he said, you're going to take summer school. And there was no reason why I needed to.
That's extra credit.
It was 100% extra credit. And so I went to a technical school for summer, and I learned several things. I took 2 different classes. One was on website design, and one was on, I think at the time, Microsoft Office, which was relatively new at the time, or, some of the features that it had. And the irony of all of this, he made me go through these and learn everything that I could learn and, ask me questions on them. And that's how I spent my summer. And, looking back, it was unfair, if you will. But the irony of this is my dad was a firefighter, so he was in that public sector for years. And now he's in the private sector doing outside sales. And I get a call at least once a week on how to use Microsoft Excel.
No kidding.
So taking all of what I learned along the way, even though it was so unfair and I didn't deserve to have to go to summer school. But, now all of these years it's carried with me, and, it's kind of the voice in the back of my head to keep going, to drive, to pursue, to push, to get where I am today.
Well, that's a great example. Yeah. And is certainly as far as what you bring to the table for WCI, I mean, I know that there's nothing that shows up on your desk that you will not take on with a vengeance and with every skill that you might have or need to have. And that's such a great quality. And I can certainly see where learning some of that mentality from back in
those
your childhood,
roots.
From your roots are still bringing you benefit today. So well, it's always a pleasure having these conversations. And for our audience, if you need any assistance or would like any help with financing a deal or negotiating how to manage through the structure of a transaction, Lindsay is an amazing person to help. And once she grabs a hold, she will not let go. And I will look forward to our next episode and all the topics we have to cover and all the fun that we've had coming up with these stories together.
It's been a pleasure.
Yeah, thank you.
Thank you.
And that's a wrap on today's episode. We hope you enjoyed the conversation and got some valuable insights into the world of buying and selling businesses. Want to be a guest on our show? If you have a deal that you'd like to discuss with us or a business story to share, we'd love to hear from you. Shoot us an email using the contact information below in the episode notes, and let's make this happen. Never miss an episode. Make sure you subscribe on Apple Podcasts, Spotify, or wherever you listen. And if you found today's episode helpful, please leave us a review. It helps more people like you find the show.